So good morning, good afternoon, or good evening, everybody, depending on where you're joining us from. Thank you for joining us today in a special 25th edition of our CVC Insider Series. Today we have a superb session ahead together with Rashmi Gopinath, General Partner at B Capital Group. Rashmi brings with her a unique and fairly non-traditional background journey, beginning working in corporate venturing at Intel and Microsoft, then joining the institutional side of investment. But before we get started, I wanted to quickly set the stage so you all have some context. First of all, my name is Alba. I'm part of 500 Startups. At 500, we're one of the world's most active seed stage investors with over 2,500 direct investments in 75 countries. And here at 500, I lead our global innovation strategy work, working closely with corporates, foundations, and government institutions to power their own unique individual journeys into corporate venturing. And we started this series, the CVC Insider Series event, as part of our efforts to help raise the bar around corporate venturing, share some best practices, and build a stronger, more supportive ecosystem for startups and investors alike. And every 2 weeks, we host this roundtable featuring some of the world's top corporate venturing practitioners and sharing their unique journey into CVC, some challenges that they faced along the way and learnings that they gained, and some of the best practices that they want to share with the rest of us. So if you have a speaker that you'd like to nominate, please feel free to send them our way. And our host, Nicolas Sauvage, will be moderating the discussion, but there's also a Q&A function, so feel free to ask any questions along the way, and we'll do our best to cover. So Nicolas, please take it away, and everybody, please enjoy.
Thank you, Alba, and thank you 500 Startups for this really good initiative for sharing best practices from real practitioners who's done it. Today, I think it's going to be really good because we have indeed Rashmi joining us and with a very unique unconventional background, using the way she described it. And I think that's going to be really nice to understand what was her journey into corporate venturing, but also how then she transitioned and saw differences with financial VC. So Rashmi, if you don't mind, maybe 5-10 minutes to introduce yourself and your personal journey into corporate venturing and then financial VC.
Absolutely. Thanks, Nicolas, and thanks to 500 Startups for this opportunity. I concur, Nicolas. I did have a very unconventional, non-traditional path into venture. My early professional career began in product roles. So I am an engineer by training and started off my career at Oracle and GE Healthcare, mainly building products, so on the core product and the core engineering team. At Oracle, I primarily focused on building database, DevOps, and analytics products. I was part of the application server suite product team. And at GE Healthcare, I mainly focused on building analytics products. So what we were trying to build at the time was a data interoperability platform that brought in data from multiple sources and provided insights to healthcare providers into care coordination and care gaps and the other critical pieces of the workflow. During my time at GE, we were in the process of launching a new product to market. I was getting pulled into a lot of discussions around pricing and packaging and product launches, marketing positioning, acquisitions, partnerships to help accelerate our product roadmap. And I would say many of the business concepts that I was still getting up to speed on, I figured that a business school degree will help accelerate the learning that I needed to be successful in those roles. And so I decided to get an MBA. So I went to Northwestern. I was doing my MBA part-time at Kellogg when I worked full-time at GE Healthcare. And I would say it was at Kellogg that I first got exposed to investments and entrepreneurship and was quite excited to get my feet wet in the process and ended up with a couple of internship opportunities during my MBA. One was with a growth equity fund in Boston that focused on growth stage equity investments. And the second was with a small private equity fund in Chicago that mainly focused on buyouts in the enterprise software space. Really loved the venture experience that I had during my time at Galen Partners. And I would say one of the things that I found quite interesting was the ability to bring in my product and engineering capabilities into the investments and the financial and the business experience that I was getting, to kind of get a more holistic perspective, especially in the deep tech spaces where you do have to be more technically fluent to really understand the product and the IP in a little bit more detail and build that credibility that you need with the founders. And post Kellogg is when I decided that I wanted to explore a full-time career in venture capital, and so ended up coming to Intel Capital post Kellogg. And at Intel Capital, Intel Capital had obviously been around for several years. It's, I would say, one of the most active CVCs, deploying north of 500 million in investments each year. I was part of the enterprise software investment team, which was still new and was getting set up. And so my role on the team was to help invest across cloud infrastructure, cybersecurity, DevOps, and SaaS. And it was I would say a great time to be part of a growing investment team. Great time to invest in enterprise software. This was in 2011, and ended up investing in some really amazing companies like MongoDB and Forescout, Magenetics, Basis, and others. And I would say it was also, I would say, an eye-opening experience to see what it truly meant to help startups and help operators in what they're doing in building the company. And I would say the experience gave me a pretty deep perspective into what startups need to do to be able to grow and succeed. At Intel Capital, we were stage agnostic, so we invested across the board from early seed stage rounds to late stage pre-IPO stage rounds. And so I would say the exposure that I had as part of Intel was pretty rich, and I would say it was a great experience working with a fantastic team, investing in some really sharp companies. One of the things that I had noticed about myself that I wanted to address was I did not have any startup operating experience. And while we can all advise companies behind closed doors on what they need to do, I had observed that the investors that came from an operating background were able to offer more realistic hands-on feedback to the company and had that trusted relationship with the founders because they had been in their shoes as well. So after about 2.5 years at Intel Capital, I decided to get some operating experience myself. And so ended up joining one of my own portfolio companies at Intel, a company called Blue Data, which was in the cloud infrastructure space. What we were primarily doing at the time was helping enterprises that were adopting big data technologies to leverage virtualization to get to scale. It was, again, a deep tech infrastructure investment, which was a space that I was quite excited about. And I wore multiple hats in my operating role. So I joined the team and it was 5 or 6 engineers. And my role was to help with everything on the go-to-market side. So started off on the product side, switched into product marketing, ended up doing business development and helping us land our first initial set of customers. And I would say it was a great experience just seeing firsthand for an early stage startup what it takes to win the first 10 customers, what it takes to establish product market fit, yep. What it takes to help build the partnerships with the large incumbents like the Microsofts and the Intels, and help the company raise a few rounds of funding, was there for almost 2.5 years. And at that point, we ended up with multiple acquisition offers on the table from the likes of Intel and HP and others. And I did not want to move back into a large company just yet. I was hoping for a little bit more operating experience. And so I ended up joining Couchbase, which is a NoSQL database startup. By the way, Blue Data ended up getting acquired by HPE. Couchbase was a growth stage company. I had known the team because I'd invested in MongoDB and I'd looked at data stacks and Couchbase as well as part of that. And my role at Couchbase was to lead the global business development team. And so I figured that I had the early stage experience and I would really benefit from the growth stage experience to see what growth stage companies needed to accelerate from that 30, 40 million of ARR to the hundreds of millions of ARR. And it was a great experience. I primarily helped build out the partner ecosystem comprising of OEMs and resellers and system integrators, tech providers. And my team was a pretty significant contributor to our revenue numbers. It was great to see how companies in the growth stage can help accelerate their top line numbers without burning a lot of operating cash. And how do you leverage your partner ecosystem to help give you that uptick in your revenue numbers by leveraging those third-party integrations or those relationships. Did that for about 2.5 years. And at that point, I was getting a few inbounds back from the investment side. Microsoft was one of those opportunities. And it was, again, a time when Microsoft was kind of getting to its peak under Satya's leadership.
Yep.
And it was the first time that Microsoft was going to set up a venture capital team. So I was quite excited, I would say, about the opportunity to build a fund from the grounds up. And the operating experience that I just had, I would say, kind of got me even more excited about the building aspect. So I ended up joining the team in 2016. I was the second person to join the team. And so it was a really exciting experience building the rest of the fund and the team. And we set off with very bold ambitions of wanting to be a top 10 CVC in 2 years. And it was very fulfilling to see that come to fruition. We assembled a great set of people. We ended up being extremely active on the investment side. I think we made almost 50 or 60 investments in our first 2 years. Our focus was more on the earlier stage. So we did anything from seed to Series B stages of investments. And so I stayed with Microsoft for close to 5 years before I ended up joining B Capital in January of last year. So B Capital is an institutional fund. We primarily focus on growth stage investments. We have just now launched our early stage fund, so we will be a multi-stage venture fund. But on the growth side, I primarily focus on Series B all the way up until pre-IPO rounds. Continue to invest in the same spaces that I covered at Microsoft and Intel. So I invest across horizontal enterprise spaces, cloud, cyber, DevOps, AI, and SaaS. We have a global presence. So that's, I would say, a common thread that I had both from my time at Intel and Microsoft as well. And we have, I would say, one of the unique models or structures for an institutional fund where we have a strategic partnership with the Boston Consulting Group. They're a minority LP in our fund, and we work with them quite closely on the go-to-market side. And that, for me, was one of the appealing factors when I joined B Capital. Was I had seen how the corporate model worked at Intel and Microsoft and the benefits that we can bring to portfolio companies. And I don't think I can point to any other institutional fund that has a similar structure. And so for us to be able to tap into BCG's network and their access into the global 2,000 customers to get our portfolio companies into those accounts, partner with BCG and get access to all of the research work that they do was quite unique and would give us that differentiation when we needed for those competitive deals. So yeah, I joined the team about 1.5 years back. I'm based out of our San Francisco office, and it's definitely been a great transition. And yeah, happy to provide any additional context as we talk about the different approaches to investing on the CVC and the institutional side today.
Thank you, Rashmi. There's so many places I want to double click. So I'll try to go chronologically from the start of your introduction. I think one thing you mentioned, and it's very true for hard tech investments, is you really need to have a good product view. You really need to understand the technology and the product. Do you think that if you don't have this good product view, you can still be a good investor? Or do you think this is really something you would encourage anyone in the audience to really have that experience? I mean, you've got the operating experience, which is clearly something I want to touch about. But what about the product view? Is that something that's a must, or?
Yeah, it's a great question, Nicolas, and it depends on, I would say, what sectors you're investing in. Obviously, I would say venture capital is a field where everyone has their own path, so there isn't a set formula that you do these three things and that leads to a successful investing career. If you're a SaaS investor, I mean, you don't necessarily need to have a technical background, but there are certain sectors where you absolutely need to, and there are certain sectors where it's a great advantage if you do. And the ones that you absolutely need to, I would say, would be things that are around biotech, for example. I don't think anybody could just wake up one day and say, well, I know exactly what chemicals and compounds are going to result in the next big drug. You need to have a technical background to do that. I would say in the enterprise side, if you're spending more time in the infrastructure space, in the silicon or the semiconductor space, having that technical background is a huge plus. That being said, again, there are investors that don't have that and have done great. And once you've done it for a number of years, you willingly or unwillingly will get that technical depth, and you will pattern match to know what a good investment and what a good tech looks like. But I would say to short charge that path, having the product and the technical experience absolutely helps. Most of the founders in these spaces are also fairly technical themselves. And so for you to, as an investor, to build that credibility and to build the relationship with the founders, they would prefer investors that have technical fluency as well, especially in those early and the mid-growth stages. Once you're close to an IPO, I don't think it matters at that point. In that point, you're just getting late-stage investors and crossover investors. But to help in that, I would say seed to Series D stage, it definitely helps when you're bringing in investors that can understand and speak to the product and help with the product vision and strategy going forward.
Yeah, I think you mentioned it earlier, and again this time, your credibility is so much stronger if you really have a good product view. You really understand the technology and so on. You also talked about pattern match. And to me, this is interesting because you could have a view that VCs is all about pattern matching. But if it's just that, then you're not going to build a contrarian view. And the product view is probably something that can help you build an insight that's different from everything you've seen before. Can you talk about the challenge between pattern matching and building something that actually would deviate from the pattern you've seen in the past?
Yeah, so I would say that pattern matching can both be a blessing and a curse. Yeah. I think the blessing is when you've invested enough in a space or a category, you know what a great team looks like, you know what a great execution looks like, you know from a product standpoint if it has these characteristics. And I think it's especially early in that seed to Series B stages where a lot of the product market fit is getting proven out and there aren't enough revenue or financial numbers or metrics to measure the company against. It is a curse because to your point, you miss out on a lot of things that don't fit that pattern, but have the ability to be big. And I'm going to throw myself under the bus by saying how it has actually hurt me when I passed on Snowflake thrice. And it was primarily, I would say, that pattern matching of knowing too much about databases and data warehousing, where my point was, it's great that Snowflake creates a data warehouse option in the cloud, but it is a data warehouse option in the cloud. And there should be one where Azure and AWS and others should have their own products. And how can you create an independent company in this space? And couldn't be more wrong. But if I would have taken that contrarian bet of, yes, there are a lot of other companies that can do it, but here is why the execution that this team is going to demonstrate is so strong, is so great, that it's going to create like a massive $100 billion company here, is going to be helpful. So I would say that it definitely is not the only way to generate great returns. It is a way to generate great returns, but I think you generate those outsized returns when you take some of those contrarian bets, when you're backing a company that you have deep conviction in because the product is exceptional, because you know the team is going to execute in an exceptional way, and when others don't see it, and when you continue to double down and bet on those companies, and when they have those massive exits, then obviously you stand to gain pretty heavily from those investments.
I love what you just said. I think it's a golden nugget for everyone to really internalize, and I'm really glad you can be candid about. I don't think you're throwing yourself under the bus, but I think it's really nice you talk about this example, which I think probably is helping you when next time you see the next snowflake. Maybe you have a signal in your head saying, wait a second, don't go too fast. It doesn't.
Exactly.
Yeah, very good. I want to go back a little bit on your personal journey. You decided to do an MBA, but my understanding is that it's during the MBA, you decided actually the investment path could be interesting. Can you pinpoint the moment where you thought, wait a second, this is actually interesting for me and I would like to deep dive into the investment path?
Yeah, and I would say that I, like I mentioned prior to my MBA, came primarily from a product and a technical role, and I wasn't based in the Bay Area. So, I mean, I started off my engineering career in India, and then when I moved to the US, I was in Salt Lake City initially, and then in Chicago. And I would say I had zero exposure to startups and venture capital during that time. And when I came into the MBA program is where I got exposed to finance and investments. And I had a very different perspective. When I started my MBA program, I thought I'd come out as maybe specializing in strategy or general management. And it's when I took my first few finance courses and my first few investment courses, I came in as a sponge, but I was like, I know nothing, and let me just try to learn things that I know nothing about and figure out like what that really means. And I would say that's when it really opened up my eyes, when I took those investment and entrepreneurship classes, in terms of this is really exciting, where you can like mix in the technical background with the finance and the business and the go-to-market side, and go from an inception and an idea into a massive company. I think that part for me was quite exciting. I've always been passionate about new tech, new software, new ideas, and the ability to do that at scale with multiple companies at the same time, I would say is like best of everything. We're all very fortunate that we get to work with extremely smart founders and entrepreneurs who truly have the ability to change the world. I know it sounds like too big and too abstract, but when we invest in these companies and we see the impacts that they have on how people work, how people function, today we discussed in our investment committee a company that helps with it's a replacement for VPN. So it helps people get access to remote applications securely, regardless of where you're based at. To think of it, it's a very boring space. Like, okay, it's a VPN replacement. But to think about the power of what it has, where in COVID, I mean, and even now post-COVID, we're going to be in this hybrid-only remote work situation for a very long time. And to have the ability to access applications from my home or from a restaurant or from any place that where I'm at without having to depend on a physical appliance in a data center that somebody has to go into the office and maintain, and I have to wait for minutes before I get access to an application. It's incredible. And so I truly do think that, I mean, we have the ability to back and partner with founders that are building amazing things. And so to be close to technology and to be part of that journey, I would say that's what I was able to discover during my courses that I was taking. And that's what got me excited about pursuing a full-time career post-MBA.
I think you've just described exactly why people should be excited about joining venture capital. I think it's if you really want to get close to technology, to founders, to amazing people, to have an impact, every morning is going to be different. You're going to keep learning. And I think you just very cogently described why people should consider going into venture capital really well. I did not know you were a founding member of the M12 team. So can you tell me what it was like? Especially you had an experience of Intel Capital. You already had built some operating experience and you had a product view. Can you tell us how you felt about starting M12 and shaping processes? Because here you really were starting from a blank sheet of paper. How was it?
It was amazing. I mean, it's always great to start personally for me, it's always great to start from a blank sheet of paper where you get to color it the way you want to color it. And so the benefit that we had was we were bringing together best practices of all the different places that we'd been at. We had people from Qualcomm Ventures. We had people that came from more traditional institutional venture funds. We had folks that came in from corp dev backgrounds, from operating backgrounds. And so in terms of setting up, I would say the core fund philosophy of here's what we stand for, the core investment processes of here's how we're going to decide which investments we want to make, how do we interact with founders, the ability to create and set up a platform team from the very first day of inception, because again, that's something that we knew was going to be one of the key things that sets us apart from other folks. I think it was a great experience to pretty much build it block by block, and then look back and see, okay, that didn't work. Like, how do we quickly tweak and move things? So we were almost like a startup ourselves. And we were, I would say, in a way, insulated away from the big Microsoft. I mean, we were all still Microsoft employees, but our team was based out of San Francisco. We had presence in India, Israel, UK, and other locations. But I would say in terms of the independence that we had on the investment process itself, the investment team made investment decisions. We did not need a corporate buy-in on the deals that we were doing, to setting up a platform team that would bring in the right resources from Microsoft to add value to our portfolio companies, convincing companies that we're not going to overly influence their roadmap towards anything Microsoft, and we're going to be partners, and our fiduciary responsibility was to help the company succeed. I think it was a fantastic experience. There was a lot of skepticism initially from the entrepreneurs and from the other investors, that we were able to get over it pretty quickly in the first, I would say, 3 to 6 months, once we had proof points of here's how we've made investments and here's how we help our companies. So it was great to see that. And that's something that I would say I look back and I feel very grateful that I was part of that journey.
It's interesting. And I'm impressed you could get proof points so quickly. I mean, this was walking the talk. So you were talking about the values and how you want to approach it. But walking the talk is where you have these proof points you can show to entrepreneurs. No, we really mean what we're saying. And I feel like M12 was set extremely well from the beginning. First, it was not Microsoft Ventures. It was M12.
Right.
You were clearly already saying, we're not quite Microsoft. We have this kind of loose connection away from Microsoft. And you mentioned earlier you wanted to be already from the beginning, the inception, you said we want to be a top 10 CVC. So tell us about how this ambition to be really at the top drove everything you did, from recruitment to setting the values.
Yeah, so I would say that setting that vision up front was great, because then you can just tie, it's like OKRs, you're tying everything back to, okay, everything that we're doing, like how does it tie us back to that goal? When we set up the investment processes as an example, our goal was to be quick and be nimble and be respectful of the founder's time. We did not want to be in a position where it would take us 2 months or 3 months to get to an investment decision. We would tell founders that like 10 days to 2 weeks is all you need for us to like get to an investment decision. And then
that's a big deal.
Exactly. And then using that to tailor our actual IC processes was important, because any additional step that we add and we're like, okay, but that does not let us get to a decision in 2 weeks. So what do we need to cut out, and what is absolutely needed for us to like get to that decision point? Same with like the adding value from Microsoft. I mean, obviously there's 2,000 things that we can do, but what are those 5 things that really matter? And how do we make sure that we put those blocks in place to help our companies get quick access to Microsoft quite easily? And we can start showing that here's how we have added value. And the easiest path for us was to partner with the Azure team. And we're like, okay, Azure has this massive presence. A lot of startups want to be on the Azure marketplace, and to figure out how to co-sell with Azure, how do we like partner with the Azure team to like quickly pull a program together that creates a win-win situation between our portfolio companies and for Microsoft? And how do we start implementing that across the portfolio? So I would say that having that goal helped us. The speed definitely helped us, because otherwise there was just no way we could have done 50 investments in 2 years. But doing that volume and velocity again got us in all of the key deals that we wanted to be in. And it also got the name and the brand out there, where the other institutional investors were seeing M12 in a lot of deals. And that created the flywheel that got us into inbound deals, where those investors would then tell us, okay, here are like 5 of other portfolio companies that would be interesting for you.
I think there's a few golden nuggets. I think, so first it's interesting, you did 15 in 2 years, TDK Ventures did 17 in 2 years. So I feel like we have a parallel path here. But I like the point about flywheel. You need to show quickly you're doing the best practices, you're respectful to entrepreneurs, you help them. I really like the golden nuggets you mentioned about you very quickly try to identify a clear value add. And in this case, you identified the partnership with the Azure team and created this win-win. We call it TDK Goodness. Did you have a name for this value add you were giving to the entrepreneurs?
I don't think we were that creative. We just called it portfolio development, and here's what you get for working with us.
But you mentioned you recruited right from the beginning the portfolio management team, right?
We did, yeah. So that was something that we had from day one.
So that's one of the things I'm extremely proud to have done at TDK Ventures is we also had day one our portfolio program manager. We call it startup liaison. It's the liaison between the startups and all the teams inside TDK. But it was challenging. I was challenged by that because when you start, you don't have a portfolio.
Right.
And so were you challenged by the fact that when you start, you already have a team that's supposed to connect startups, the portfolio companies to the teams in Microsoft, but you don't have anyone yet. So how did you get started and were you challenged by this decision?
So I would say that the initial team that came together all came from other venture funds. Like we had folks from Qualcomm Ventures. I had come in from Intel. We had one of the other partners that came in from Trinity, which is an institutional fund. So because we all came from, I would say, more of the other investment funds, we had a pipeline of deals that we were already looking at. So I would say the first 5 investments were pretty much done within the first month. That gave us, I would say, at least a base of some portfolio companies that we could then like help through with the Azure and the Microsoft teams. I think the challenge was always that we had too many companies and we didn't have enough platform resources that could support all the companies. And so there was a prioritization that we had to do where we would say that, okay, for the next 6 months, like these companies get more hands-on support, and these companies are going to be more of a passive, like we help them when they ask for help. And that would keep rotating around so that all companies get the love and the attention that they need. But I don't think we ever ran into a situation where there wasn't enough for the platform team to do the complaint because there's too much, and how do we prioritize?
Very nice. I really like that. And so maybe one last tip about M12 starting on the recruitment. I mean, we talk about D&I. At the time, what was your approach to recruitment? So not the portfolio companies, but the CVC itself.
Yeah, so D&I was always extremely important given the Microsoft brand. I'd say that on the investment team, we had 3 senior female partners that had the ability to write checks. We also had 2 people on the team that came from like an underrepresented minorities category. So D&I was always important. And the key to, I would say, getting the right diverse team is to make sure that a pipeline is broad enough and you're not just looking within your network, because when you look just within your network, you tend to like bring in people who look like you.
Yep.
And so if that filter is broad enough, and that's something that even at B Capital, we hold ourselves to a pretty high standard. We have almost close to a 50% or 48% representation across the investment team in terms of gender diversity. And then the underrepresented minority representation is something where we need to get the number up. It's good, it's not great. But that's something that I would say there's a very active, conscious effort in terms of how we do it. So when the pipeline is built, we make sure that we have a fairly diverse candidate pipeline that's coming through. And during the interview process as well, we make sure that we're trying to be as unbiased and agnostic as possible. And the interviewer panel is also diverse. And that way, like we're making sure that we get the right representation of folks across the board. We've also chosen not to hire people when we know it's going to cause an imbalance in the representation numbers that we need to hit. So it's just making sure that we have the right KPIs as a team, and then our recruiting process is tailored to hit those KPIs.
I think the last tip you're giving, or the last practice you give, is the most difficult one, because you found someone who really fits well, but would actually create an imbalance, and therefore you're waiting for the next candidate. And right. This can be very difficult to do. So how did you manage that?
It is difficult, but like I said, at the end of the day, we wanted to make sure that the team had the right diversity numbers, because again, I'm a huge believer in this, and I'm sure most people agree that diversity leads to the best outcomes. And so when you do find somebody who's a great fit, but unfortunately looks like the rest of us, then I think it does make sense to give it a little bit more time and wait till we find other candidates that fit the bill. Venture again is a category where you typically don't have people moving around too much.
Yeah.
So once we bring someone on board, the expectation is that person's going to stay with us for the next 5 to 10 years. And so waiting for that right person with the right background is extremely important. And diversity is something that gets represented, I would say, in multiple facets. It's gender, it's background, it's experience, it's cultural, it's race. There's just so many aspects to it. We tried to hit as many of the check boxes as possible. So yeah, I'd say that I was pretty happy with the processes that we had, and it's something that I continue to hold our team accountable to, even at B Capital, where we have said we have paused searches when we know that it's not hitting those diversity numbers that we need on the team.
Yeah, no, that makes a lot of sense. And I think you mentioned it, but in venture capital or CVCs, people stay for a long time, but also it's very small teams.
Mhm.
So one person really, really matters. Each person really, really matters. So the decision point is really important. I want to move into the core of the interview, which is really about differences between CVCs and VCs. And clearly you've been in both. You've practiced, you created a CVC, you were the founding member, and now you're at B Capital. Maybe we start by why did you join a financial VC? And then maybe you can tell us about what are the things that are so much easier or better in a financial VC? And of course, we will do the flip side afterwards.
Yeah, absolutely. So I wasn't actively looking to leave M12 when I joined B Capital. There were inbounds coming my way. Most of them were from, I would say, the traditional VC funds. There were a couple of aspects about B Capital that was quite intriguing and got me excited. One, like I mentioned, it's very rare, or I would say I at least haven't seen any other institutional fund that has this sort of a corporate partnership right from the get-go. And this partnership that B Capital has with BCG is fairly unique, and one that I pressure tested before I joined, because it's fine to say, yes, we have a partnership, but how much of that is real?
Yep.
But in terms of how active BCG is with the portfolio companies, how they've helped move the needle in terms of getting that top line growth impact, getting that extra credibility through thought leadership, joint events or joint articles, and leveraging the strategic consulting experience that they have on a number of research topics that could be interesting for our portfolio companies. I think that is very unique. It sets us apart quite nicely. And one that I had a lot of experience doing. I'm like, I know how to work the corporate network. I know how we can build that to gain that competitive advantage that we need on the institutional side. And so I was quite excited to see that on the institutional side. Honestly, like if I were to start a VC fund, this is how I would do it as well.
You mean everything you've done in your career, every experience you built was like perfect to join B Capital?
Exactly. It was, and again, my role was to help lead our enterprise software investment practice. Again, something that I've been doing for the last 10, 11 years and had operated in as well. And I would say the second aspect was this broader role that I had, which was to lead all of our global enterprise software investments, and to do that at a global level, which is also something that was interesting and a little bit different than, I would say, the traditional institutional investors, where you have regional teams. Like you have a US team, you have a Europe team, you have an Asia team. We have a team in Asia as well, but I would say that the focus that we have at the partnership is across sectors and across geographies. And so even if this is like if we take cybersecurity as an example, like I would still lead a cyber deal in Asia or in Europe or in other regions. And so being able to leverage a global platform and to be able to cover a sector from a global perspective was quite exciting as well. So, I mean, those were the primary reasons why I joined B Capital. And it was, like I said, unique and differentiated and not something that I had seen very commonly with other funds.
And so what's big pros of joining a financial VC? And clearly this is not a pure financial VC who doesn't connect with corporates, but what do you find liberating maybe?
So I would say both Intel and M12 were a little bit unique with the investment team structure that we had. is that the investment decisions were fully autonomous and independent. Unlike, I would say, certain CVCs where you need to get a corporate approval or a buy-in on investments that were done, we did not need that at M12 or at Intel. And so I would say, like, the more traditional answer that you would expect is, well, I don't need a corporate buyout, but I didn't need that at M12 or Intel.
It was already good.
Exactly. So it wasn't that. The only thing I would say is, at least at M12, there were certain swim lanes that get created because, and this is not because Microsoft instructed us to do that, it was because of the nature of the business that Microsoft is in.
Yeah.
Like, for example, I don't think we would invest in a company that would provide like an Office compete, or we would invest in a company that created a CRM, because there is no value add that we can provide at that point if the company directly competes with what Microsoft is doing. So as a result, we would shy away from certain categories where it wasn't clear on how Microsoft can add value. As an example, I think, like, I really wanted to invest in Airtable, looked at the deal 4 times, but could never like get it past a certain stage because it was directly competitive with what Microsoft does. One of the other investments that I ended up doing at B Capital was in DataRobot, which is providing an AI platform that democratizes access to AI and ML platforms. One that I had tracked since 2017, tried to do the deal thrice through Microsoft, but could never get it done because the management team was concerned about direct competitive overlaps with what Azure was doing. So that, I would say, opens up the doors of possibilities of what I can do at B Capital because we don't compete with anyone.
That's a big one. Actually, it's interesting because you are independent in the investment decision, but you can still be influenced by the mothership being concerned about certain investments. So it's not that you needed a buy-in, but still you would listen to what they said. And if they were concerned, then maybe you wouldn't invest.
Right. Yeah. And I mean, there were also instances where there wasn't a direct competitive overlap at the time of making the investments, but maybe 2 years post that, Microsoft launches a product that competes. And that's beyond our control. So I guess in those cases, like, we would really ask the company, like, what do you want us to do? Like, we're happy to step off the board, give up our info rights, if that makes sense. In most of those instances, I would say because of the relationships that we had already built with the management teams and the boards, like, we still stayed on the board, but we obviously had to be mindful of how much information sharing goes back and forth between Microsoft and the company.
It actually goes to credibility. You have to make sure that there is no perception, not even fact, but perception that information could flow the wrong way.
Exactly.
Yeah. Now let's talk about the advantage you've lost by moving from a corporate VC to a financial VC, because you talked about a lot of the win-wins that you created between the mothership and portfolio company. What is one thing you miss the most from being in a corporate VC?
Access to technical diligence. I could pretty much do that like in a few minutes, where I could just like ping one of the product teams at Microsoft, and in most cases they would have either used this startup product already, or they'd be able to take like a quick demo and tell us like how good or bad the product is. I try to maintain that still at B Capital through the relationships that I have with folks on the technical side. But it's just so much easier when you're part of Microsoft and you can just like, if it's an AI company, just like pick up the phone and speak to like one of the data scientists at Microsoft and ask them what they think.
I think it's an unfair advantage of CVCs.
Exactly.
When we look at battery companies, we have the world's expert inside TDK. Exactly. So I totally relate with the quality of the due diligence, very fast, very deep. Like very few people can get access. Can you give me another thing you miss, maybe?
I would say the brand and the reputation is another one. And I would say while M12 was a new entrant in the CVC space, this is where we would cheat and we would like pull in the Microsoft name whenever we
Whenever
wanted
you
to win.
could.
Exactly. Whenever we wanted to win a competitive deal, like, whoa, we can bring all of this resources and access to Microsoft. And I would say for most institutional funds, it takes time to build brand. The investment market is insanely competitive and everybody looks the same to a founder. And so to kind of set us apart, we have to be creative about what we can use to our competitive advantage. When it comes to CVCs, it's very obvious. Like if you're taking in money from Cisco, you know what Cisco brings to the table. You're taking money from Salesforce, you know what Salesforce brings to the table. With Microsoft, with Intel, with TDK, I mean, it's very obvious. You don't have to come in and explain why you need to be on the cap table. For the institutional investors, it's difficult. And unless you're a Sequoia or an Andreessen or a Lightspeed, where your brand is established and people seek you out, for the rest of the institutional funds, the competition is fierce. And it's a lot of it depends on the individual GP's reputation, what they bring to the table, as well as like what can you do in terms of unfair access to the CXO network, which is what we're leveraging BCG for.
Very, very nice. Actually, when you talk about differentiation, a corporate VC has an unfair advantage. It's got this connection to the mothership. And I've seen many CVCs being very cautious about mentioning the mothership, but actually this is your unfair advantage. You need to find a way to embrace it and leverage it. Right. I think what B Capital is doing is very smart. You're leveraging something that's very obvious and can add value. How difficult is it beyond what you're doing with BCG to create even more differentiation?
Yeah, so this is where, again, from a platform capabilities, we've been quite laser focused in terms of what do startups care about and how do we offer it to them. So today, our platform capability has 4 key pillars. One is on talent and recruiting. So it's not just helping our portfolio companies with recruiting efforts, we also bring in the expertise to help with org design, org structure. How do you build a high-performing team? How do you roll out a performance review process? Like how do you adopt OKRs and all of that? So it's a lot of design and structure along with the more tactical, we can help you recruit your next CMO. The second key pillar is around capital formation. So we have a team of experienced ex-bankers on our platform team that can help with exit opportunities, tuck-in acquisitions, venture debt, future fundraising, alternative fundraising options, which again become quite helpful and meaningful for companies at the growth stage as they're thinking about what are additional capital sources that they can tap into. The third key pillar is around the CXO network. So in addition to BCG, we have our own business development team that builds a CXO network across different industries and sectors that we can tap into. So we did one for financial services recently where we had our portfolio companies come in and pitch to them. And then the fourth one, which we call as strategy and ops, is basically we have a team of ex-strategy consultants on our platform team that can help with anything around assessing a new market that our portfolio companies want to go into. What is the best practice around launching a new product? Many of our portfolio companies have multiple product lines. And so we can do a pricing optimization study to say, here is like how you would want to tweak the pricing for these particular segments or these particular use cases. So that's in addition to, again, what BCG brings to the table. And that's something that we continue to be creative on in terms of what else can we be doing to help our portfolio companies, and as a result of that, help differentiate us. Because at the end of the day, we want to go back and create case studies and say that we did X, Y, and Z for these companies, and we were able to influence their growth from, I don't know, 50% to 80%.
Yep.
And that becomes then something that sets us apart.
There are many golden nuggets you're describing, and a virtual circle really where you keep improving and adding more pillars, all about helping portfolio companies that then will rave about you, case studies, and you continue. And what I also liked is you're extremely clear about what is the value you bring and how it's structured. It's not like you have to think about it. You live and breathe this value add to the entrepreneurs. Do you have any way of closing the loop with the entrepreneurs where you ask them what they value the most, what you should accelerate, maybe what you should do less of?
Yeah, absolutely. So we actually run surveys with our portfolio companies every quarter, where we ask them to rate us on the projects that we've delivered for them.
Oh, very nice.
And what are some of the proof points that we can see? So the easiest to measure is the recruiting efforts that we help with, where we can see how many people have we placed and how much of their pipeline have we influenced through customer introductions. I think the more nuanced ones are these strategic projects where if we are running a pricing study or if we're running a new market study. So that's where we get some of the more contextual feedback through these surveys that we run with our portfolio companies. But they're like the best judges of how effective we've been.
Exactly. The value add is only value add if it's appreciated by the recipient. Exactly. Is your survey like an NPS survey or is it more of an open question survey?
So the survey is both. We ask them to rate us. So that would be like an NPS on the projects that we've run, but then we also take a lot of open-ended responses back from them in terms of what else we can be doing, how else we can be improving.
And if at very high level you were looking at the full resources of B Capital, how much percentage of your bandwidth do you think are deployed to help entrepreneurs, your portfolio company?
I would say that the platform team is as big or probably bigger than the investment team. Our portfolio today is about 70 companies. So yeah, I would say the investment team is about 25, 28 people. The platform team is at least 30 or more.
Okay, that is actually a fact. This is really very clear. Very nice. Can you talk about the stage? I think we are 2 minutes left. So you had experience of stage agnostic investments with Untitled Capital, then early stage investments at M12. Now you're more at growth stage investment. Any tips to the audience about what you've learned of doing these three very different disciplines?
Yeah, so I would say that what the investors look for at the different stages is slightly different. There are some common threads. I would say team is common across the board. It doesn't matter whether you're a seed stage company or a pre-IPO stage company. The investor is going to ask like, who's the team and who's running the ship. At the early stage, I would say it's a bigger bet on the team, the product idea and the TAM. And as long as like those are like proven out, those are interesting enough, like that's what drove the interest levels. At the growth stage, I would say becomes more of a science than an art. There is a lot of numbers and metrics that we look at, but our definition of growth is fairly broad. We can do Series B and we can do a pre-IPO round. At the pre-IPO round, it's primarily numbers driven and like how big do we think this opportunity gets. At the Series B and C stages, it still is a lot on product market fit. How is the team executing? Which segments are they winning today? How do we help them grow bigger? So I would say some of the nuances are similar at those early growth stage, and then at the late growth stage, it just becomes more financially driven.
Thank you, Rashmi. I think this was an interview very rich of insights, golden nuggets, best practices, and I think your journey is amazing because it feels like it was conscious. I'm not sure if it was always conscious, but you build skills that are necessary for you to be really performing where you are today. So I look forward to meeting you face to face as soon as we can. But thank you for your time and sharing so much. Thank you.
Totally. Thank you so much for the time and for the opportunity, and look forward to speaking again.
Thank you. Bye.
Thanks, everyone.